Hello everyone, my name is Radovan Vojtko, I'm CEO and Head of Research at Quantpedia. Today we will discuss seasonal anomalies. So what are the seasonal anomalies? Seasonal trading strategies are those that are built around the events that regularly or periodically occur in the markets. It can be, end of the year, end of the month, beginning of the new month. It can be the presidential cycle. So, every 4 years there is a new president elected. It can be seasonal patterns that are related to harvest season. There can be seasonal patterns related to public holidays, etc., etc. The most interesting and most important seasonal patterns are those that are connected to macroeconomic announcements. And the most important announcements come from central banks, of course. So there is one market wisdom that says don't fight the Fed, and academic research agrees with it. So there are a lot of the studies that show that there is a strong price action around the Federal Open Market Committee meetings. So the Fed started to be less secretive, and every few weeks they have a meeting and they explain the monetary policy, and it's widely followed, and there is a strong price action before that policy announcement. But this is the US Central Bank. Of course, the US Central Bank is the most important one. It's the biggest one, the biggest economy, etc. etc. But it's not the only central bank. So our question was, is there a drift in the prices around announcements when the other central banks announce? And yes, there is. So what we uncovered is that there is a pre-ECB drift, and we can use this drift and we can trade the US markets, or you can trade the European market, and we can build interesting trading strategies. As we mentioned before, there is a strong positive drift in US equities on days surrounding Federal Reserve meetings. Interestingly, there is a shifted pattern in European markets around the European Central Bank press conference. So what our quantitative analysis reveals is that European equity markets tend to exhibit strong upward drift on the day before the ECB scheduled press conference. So not at the day when there is press conference, which is the case of the US, but the day before. Of course, the question is why it's the day before. And can we be certain that it makes sense to trade this anomaly? Yeah, we can be certain and we can trade this anomaly, and there is a very logical reason why the drift is the day before and not the day after. But we will get into that. What we did is that firstly we downloaded data. So we downloaded data for European indexes such as DAX, which is a German index, or Stocks 50, which is the broad European index, and then we download the US ETFs like SPDR US Stocks 50 ETF, Vanguard Europe Stock Index Fund ETF, iShares MSCI Germany, and Wisdom 3 Europe Hedged Equity Fund ETF. So those are the ETFs that are traded in the US. You can trade them as a US investor, or if you want and you are a European investor, you can trade the DAX stocks, or all of the other ETFs that are related to the European market, or you can trade futures or whatever. So we downloaded the data, and then we downloaded the ECB conference dates. So when there is a ECB conference, you can easily find that going on Google. So I can go to Google and you can find the ECB press release history. You will get the European Central Bank webpage, and here you can download all of the dates, all of the press releases, and you can even find what are the future press releases. It's not a problem, and you can easily find them. So here we have all of the list and all of the press releases, and you can download them, and you can download the press releases that are connected to monetary policy. It's easy. So we downloaded the dates. ECB meets 8 times a year, so they have plus or minus the same schedule as the schedule in the Fed. The Fed also meets 8 times a year, plus or minus all of the central banks have approximately the same schedule. Okay, what we did after that is that we checked what is the price action before and after the ECB meeting dates. So here the blue line shows the performance at the time when the ECB meet. So it's a D0 day. The green part shows what is the performance the day before. So as you can see, there is a strong upward drift the day before and the downward drift in the day after. If you try to translate the drift the day before, how will the performance look like? So here we have the equity curve of the pre-ECB effect for the DAX index, for the German index. So we can see that if we buy the day before, we will have nice performance. Here we have the equity curve for the broader stocks index. We still can see that we have a positive performance, not so great as in the case of the Germany. So it seems that ECB meetings have the biggest impact on the performance of Germany market, because Germany is like workhorse of the European economy. What was our interest is that, this is the day before, but the ECB has a press conference or press release at 2:15 European time, which is 8:15 of the US time, so New York Stock Exchange time. So it's before the US Stock Exchange opens. The European markets are open, but American markets are closed at the time the ECB has a press conference. What we were interested was to see what is the performance during the open to close and close to open sessions. So we split the performance over the whole day, so from Tuesday to Wednesday, into the open session, the market open session, so that's the session when the market in Europe is open. For the close to open session, so that's the session when the market in Europe is closed.
Unlock the power of Quantpedia Pro with over 900 premium strategies extracted from 100,000 research papers and more than 30 quant reports. Model full portfolios, generate real-time reports and save hours of work. Quantpedia Pro, your edge in quantitative investing.
And here we have the session returns. So we can see the open to close performance for the DAX, and we can see that the day before, when the market is open, the performance of the DAX is positive. During the day of the press conference, when the market is open, the performance is negative. So what does it mean is that already it doesn't make sense to hold the European equities at the morning of the day when the ECB has a press conference. So it makes sense to hold them the day before. Now, what about the night? So it makes sense to hold the equities during the night before. So D0 is the night before the conference, D1 is the 2 nights before the conference, D+1 is the night after the conference. So it makes sense to hold the European equities all the nights around the conference. It just doesn't make sense to hold the European equities right at the time when there is ECB conference. So what does it mean is that it seems that this pattern is basically the pattern. So here we have a chart, what will be the performance when you will hold the European equities right at the time when there is a conference during the open to close session when the ECB has an announcement. So what does it mean is that it seems to us that this is the effect basically related to, let's call it, buy the rumor, sell the news pattern. The announcement itself is not so important. What is important are the expectations of the traders before the announcement. There are the traders who buy the markets before the ECB announcements in the expectation that ECB will do something. But once the ECB is doing something and announcing something, the markets already reacts negatively. So it makes sense to hold European equities before, but not during the announcement. Okay, now let's take a look on the analysis of the US ETF. So all of those data were in the European indexes, but if you are the US investor and you want to trade, how you can trade it. So what we can see is that there is a pattern in the data 2 days before the ECB announcement, and after the announcement there are the negative performance. So once again, it makes sense to hold European equities the 1 day before the announcement or 2 days before the announcement, but it doesn't make sense to hold US equities at all after the announcement or at the day of the announcement. Even from the point of view of the US investor or US trader, it's still buy the rumor, sell the news, hold the European market before the ECB announcement, but not during the announcement. So what we tried after that is we tried to really check out if the performance is the caused by upward drift in the markets, in the global markets, in overall global market, or is just European specific. The easy way how to do that is that you calculate the spread between the performance of the Germany, so between the EVG ETF and the performance of the US market, so the SPI ETF, and then you take a look on just the spread. So in this case, how we can imagine how we will trade it is that instead of buying the ETF outright, we will buy the spread. We will go along the EVG ETF and we will short SPI ETF and we will just play on the outperformance of European market. And we still have the same pattern. So European markets outperform 1 or 2 days before the ECB announcement, and they are strongly underperformed after the announcement or at the day of the announcement. The drift is really caused mainly by the traders who tactically shift into the European market before the ECB announcement, but they do not want to hold the European equities during the announcement. The optimal time when to sell Europe is to sell it during the night before the ECB announcement or at the morning before the ECB announcement. But at the morning before the ECB announcement, the US markets are already closed. So if you are the US investor, you want to sell European equities before the ECB announcement. And if you do that, you can have the interesting performance. If you try to put it into the numbers, the annual performance is around 3%. What is important to understand is that it's just 8 trades. So for 8 trades, you can have 3% annual performance. So this strategy is very easy to implement, and I mean, you can boost your performance by just doing 8 trades a year. So you can, I mean, use this as an overlay for basically any trading strategy you use at the moment. So I hope that you like this analysis. This pre-ECB drift is very similar to the drift in the markets before the Fed meetings. What we plan to do in the future is that we plan to check the Japanese central bank announcements, because I mean, Japan is like the third biggest central bank. We have the hypothesis that even in the Japanese market there is a drift before the announcement of the central bank. And I mean, if you combine all of those three central banks and their announcements, I mean, you can have like really interesting trading strategy and not particularly complicated. So thank you very much. I hope that you liked this video. Please give us the like, subscribe to our channel, subscribe to our social media channels, subscribe to our newsletter, or just visit Quantpedia. And I hope that you will join me in the next video.
Are you interested? Then pick another video to learn more, or subscribe to Quantpedia Pro and try how our analytics and reporting significantly save time spent on quantitative research.